I'm Bianca, Philogene, a portfolio manager at 10x. Let's answer some investment questions from the internet. This is Rands and Sense by 10x. Deleted says, I'm confused with what is happening in a fund fact sheet. Don't worry, Deleted. This is pretty common. I can help with a couple of key things to look out for. First off, there should be an information block in the fund fact sheet. This is going to tell you the risk profile of the fund as well as the suggested time horizon. So this will help you determine whether this fund is the right investment for you. In that same area, you should find the costs to invest in this fund. That's also a key piece of information to look out for because the return you will earn is always net of costs. Then a really important area is the performance. Here you should see a 1-year performance, a 3, a 5, and maybe even a 10-year. This is good to tell you how the fund has performed historically, and you can also use it to compare to other funds or other benchmarks that you know of. And finally, there should be some value-added information such as asset allocation. This will help you understand the mix of assets that you'll find in the fund. And if you are a high-risk investor, you could look for a bigger allocation to equity. If you are feeling more defensive or you'd like to preserve your money, you'd look for a bigger allocation towards cash. On to the next question. Bill Chops asks, if my investment horizon is 20 years, do I need to diversify with bonds and property, or should I just be all in on growth ETFs? Well, what is diversification? Diversification is when you buy more than one asset and potentially a mix of bonds, equities, cash, and property versus just holding one asset class. And what this can do is this can really help protect your investment because diversification means that these different assets will perform differently in different market conditions. There are a couple of pros to diversification. Diversification of your investment will mean that you have more stable returns over your investment horizon. You will find more protection should your time horizon unexpectedly change or shorten. And finally, you are less likely to be emotionally driven should you invest in one asset class that is either underperforming or overperforming. There is a potential con to diversifying rather than buying a single asset class such as all growth ETF, in that you could potentially forego some of these high returns, but this would depend on whether you invest at a reasonable price. There is an old saying, don't put all your eggs in one basket, which really means diversification is important. On to the next question. Crypto Critical 9001 wants to know, how do you deal with friends and family who keep making bad financial decisions? Crypto Critical, we all know someone who's making a poor investment decision. What you can do, or some of my suggestions, is to try and educate that person by providing them with some easy and simple to understand resources about investments and spending habits. Try keep your suggestions to helpful and encouraging rather than criticizing, as you're more likely to get this person's buy-in. And finally, you might have to realize that you just can't control them. And what's going to be in your best interest is to step away and not let your own investment and spending decisions be impacted by those around you. The next question is from OK Replacement 4477, who asks, are Kruger Rands a good investment? Gold has been known to be a store of wealth in uncertain economic times, and this is why some people look at them as favorable investment options. This is one of the benefits of buying a Kruger Rand, as well as being able to get access to gold, which you wouldn't ordinarily be able to, as gold bullions are not freely purchasable. What are the cons? Well, buying a Kruger Rand might require a large initial investment, which some don't have, and it's also challenging to understand when is the right time to buy a Kruger Rand. If you're interested in getting exposure to gold but can't afford the initial amount for a Kruger Rand, you could look at purchasing a gold ETF on the JSE exchange. Strump says they have $10,000 a month to invest and want the highest possible returns after 5 years. Well, Strumps, returns are not completely independent of risk. And so investing in a high return asset class such as equity is also going to introduce a lot of risk into your portfolio. And you really need a balance or a mix of assets, which will introduce some diversification into your portfolio. If you were to go for an equity asset class which would give you the highest return, it could also mean that your investment will underperform over 5 years. 5 years is also considered a very short time frame for a high-risk investment. And so it seems like a sweet spot could be a high-risk balanced fund for your need. OK Estimate 5668 has money in cattle and delivery bike investments and wants to know where there are other alternative investments they should consider in South Africa. Alternative investments are unlike your traditional equities and bonds, as these are not listed on a stock exchange. Some examples are private equity or impact investing. What's important is to consider the following before purchasing alternative investments. Often, these type of investments have lock-in periods, meaning that once you've invested your capital, it might be only after a certain time frame that you're able to get your capital back. These investments are often also illiquid, and they carry quite high fees and high minimums to invest. Finally, you should also consider whether you have the right experience and expertise to purchase these type of investments in your portfolio. What it might be worth doing is first considering your portfolio foundation, which would be making sure that you have a retirement pot, an emergency fund, any savings for short-term goals, as well as even a tax-free savings account. Once your foundation is right, and there is perhaps still funds for alternative investments, you could look at an experienced fund manager to gain access, or you could look at Fed Group, which would give you direct access to impact farming such as beehives, macadamia trees, or solar panels. Nuclear Pop-Tarts asks, why do passive index funds beat active investors in the US, yet the opposite is true for foreign markets? Nuclear Pop-Tarts, this actually isn't the case. Studies have shown us that passive funds actually often outperform their active counterparties. S&P publish an annual survey known as the SPIVA scorecard. And what the scorecard looks to do is it looks to compare active fund managers and their performance against a relevant index. These findings indicate that index funds beat active across local and foreign markets. If we look more closely at South Africa, we can see that active fund managers almost always underperform the relevant index over all time frames. This was the same in the US, Europe, as well as other emerging markets such as India and Brazil. Looking now at bond funds, locally we can see that over shorter time frames, active funds have outperformed their indexes, but periods longer than 5 years, they have underperformed their index. Offshore, we can see that bond indexes outperform their active counterparties at all time frames. What does this mean for investing? Well, if you're looking for equity exposure, it might be worth buying a low-cost equity index, as these are seen to outperform active fund managers across various markets and all time periods. If you're looking for bond exposure, it might depend on the time frame. For a short time frame, it might be worth buying an active fund manager, as these have outperformed their indexes over 1 and 3 years. But anything longer than that, again, buying an index will likely outperform an active fund manager.